Hello, I'm Adam Grimes, and I want to take a few moments today in this video blog to go through some trade setups that were published on my blog, adamhgrimes.com. And if you found this video someplace else and you like what you see here, maybe check out my blog, and you can also follow me on Twitter at adamhgrimes. So I want to look at some trade setups that I published, and this is not so much to see what happened with these specific trades, but to think about the kinds of trading decisions that we might make and the kinds of expectations that we might have out of these setups. So generally speaking, I will publish consolidation trades, and there'll be pullbacks that will probably require an entry trigger. So the way you should say this is, or the way you should think about this is that you're generally requiring some kind of strength. And whether that's a close above the previous day's high, whether it's trading above the previous day's high, whether it's a strong close, generally speaking, you want, with these types of setups, some evidence the market is moving in your direction. Then there's the question of stop location, which is really, we'll touch on that, but that's really a separate discussion. So here is a blog post that I made. It's now August 27th. So here's a post that I made August 8th. And looking at DLR, we had a long setup in DLR, and that was, just so you can see, in this general area. And you can see a buying strength would have given you a reasonable swing. Your initial stop could have been a point or so, point and a half maybe, under your entry. And this is a winning trade. Keep in mind, these are swing trades. We're not looking to buy this stock at 64 and get out at $640. That's not the way these trades work. And what I would call your attention to is this large standard deviation down day, and that's what we see. This indicator here is what we call our sigma spikes. It's just each day's move is a standard deviation of the previous 20 trading days. It's basically a volatility adjusted measure of price movement, and this is a -3 sigma day. So certainly, and you can see on the chart, certainly a large day, and then these tight consolidations. So if you still were long this is more of a setup now for a short, and your stop could easily be located somewhere just under current prices if you're not already out of the trade. So there is number one. And I apologize, this is going to be a little bit of a longer video blog, but there are a lot of setups to look at. So we're looking at a potential breakout in RGLD, which was consolidating right around 78. And just by way of reference, that was here, I believe. Yes. So if you look what happened, and here you see trade management matters. Your initial stop probably was somewhere here. This might be a little bit wide, certainly could have been down here. And if you look at this distance, you came, if not exactly, very close to having what we would call a 1R win, meaning that your profit at this point was equal to your initial risk in the trade. And then another consolidation. Now notice that this also follows not as strong of a failure, but this is not what we would hope to see. So after a breakout, it's fine to have a breakout. I actually probably should have drawn that in blue. It's fine to have a breakout that goes up, pulls back, and consolidates, and then goes higher. This is something that we do see a lot. What we don't want to see is this consolidation sitting right on the previous level. That's more indicative of a failure. So this is a trade that, had you traded the setup, probably would have been a scratch, or a small win, small loss, or a scratch. A long trade in VIPS. So this also was here. And same situation. This probably would have been a small loss or perhaps a scratch. And now you see we're still consolidating. This looks like potentially a setup, some kind of triangle. Volatility contractions, no surprise to see volatility contraction at this time of the year. Do notice the weekly chart is pressing into the upper channel, and that's a pattern that I'm sure if you Google, you find on my blog. I talked about a slide along the bands, and I mentioned that in the book also. This is a market that you would not want to short. This is typical of a market that, at least on the weekly time frame, just relentlessly pushes higher with no real pattern, no real pullback, and that in itself is a type of pattern, the absence of pattern except for strength. Had a potential short set up in FNSR, and that was here, and really probably no trigger. So you probably would not have been triggered short. If you were triggered short on this day, this is not, certainly not real big on candle patterns, but this is a day that shows a pretty clear failure test or a hammer below previous lows. Not a day you want to go home short, or if you do go home short, you certainly can have a very, very tight stop. So in other words, if you, let's say you were triggered short on this day somewhere around here, maybe your initial stop is somewhere around 21.5. After you see this action, it would make sense, even after the first day, to tighten the stop down. So you're looking at a loss that's maybe 25% of your initial trade risk. However, I would argue that there probably should have been no trade entry there. Now let's move. So those were 4 trading ideas published on August 8th. Here is a set of 6 trading ideas that I published about a week ago on August 20th. So we were looking at a potential short in VGK and European stocks. And this trade has not triggered yet. I'm actually going to pop over to some cash indexes. So here is a cash index for France. And one of the ways that we talk about pattern failure is by, and this is in my book and it's on the blog too. I mentioned the book not to sell books, but because I think it will help understanding. So if you're at all confused about any of these concepts, clarification is probably in the book, and it's just nice to have for a reference. But certainly can find this information on the blog too, and in the trading course, which is absolutely free. One of the ways that flags fail is by a strong thrust against the pattern. So we were looking at here in France a potential bear flag, and what we got instead is a sharp thrust up out of the flag. Not a decisive failure, but you don't really see that. This is why sometimes it helps to be aware of a little bit more of what's going on in the market. This pattern in VGK, particularly on the weekly chart, still probably looks valid. I would argue that perhaps we're seeing the beginnings of some breakdown of the shorts in some of the member nations of the EMU, so worth keeping an eye on. A long trade in Tesla. So this is actually a very bullish setup when you have a lot of kind of back and fill, chop and slop, and then when we start to see tighter consolidation, and again, it's late August. This is a horrible time, generally speaking, to be thinking about putting on new trades, but still, this is potentially very bullish and is a pattern that might be able to overcome some of the late summer blues. We had a long setup in ADM, and we still have a long setup in ADM. So this is if you look at the difference. So we're still within the confines of the pattern. I'm writing a lot in the blog now about the art of finessing these patterns. And we have a statistical tendency. When a market makes a strong thrust and then pulls back and consolidates, that gives us a setup for another thrust in the same direction. And you see a lot of these patterns are the same thing. And when we have that setup and then we have a strong move against the pattern, I won't go to VGK because that's a short, it's potentially confusing, but this RGLD where we had the strong standard deviation breakdown and also DLR. This is not what we expect to see happening with a long trade or a long setup. Notice that we don't see that with ADM. What we do see a lot of down days, see a lot of black candles, but if you look at you can see with the chart, And here again, art. If you look at what the sigma spikes are telling us, all of these are very, very small standard deviation days. But you don't need to do that because you can see that on the chart. You can see visually we're within the confines of the pattern, and so this is still a valid long setup. And I'm moving rather quickly. I don't want to make this too long. I know video blogs need to be relatively short, and as much as I talk, it's hard for me to keep my comments short. CSIQ. So here we had a potential long setup. I said it probably needs a little bit of time to consolidate, and this is not really the consolidation. We would prefer to see the consolidation somewhere in here. When we see the consolidation bleeding higher, to some extent, it's like opening a pressure valve and releasing some of the potential in the trade is one of the ways I think of it. There's still probably a trade here. You should have had no trade entry. If you are long, I would recommend using a fairly tight stop on a pattern like this generally, but this is probably one that needs a little bit more time. And then only two more here, and these are not stocks, but said quite likely more downside in the euro, and we have had more downside in the euro. There's really a tendency, and I think there's a tendency in traders' mindsets, and there's particularly a tendency in social media to want to fade trends. So, be careful. A lot of the ideas that you might see on Twitter, a lot of the ideas you see on stock twits are aimed at people trying to pick bottoms, and it feels good when we do that, and everybody's, you want to be able to say, oh, I called the exact bottom in the euro, but that's not generally the best way to make money. You can do that, but it's a very specific investment strategy, a trading strategy, and you're going to be wrong a lot. And so it's certainly something to keep in mind, that when you see a market has made an extended move in one direction, there's going to be a lot of calls for that move to be over, and just be aware that's probably not the way you want to trade a lot of these moves. You want to you basically want to look for continuation. And on the same note, a potential, everybody's looking for a long in grains, and we don't see that. And soybeans have continued to drip a little bit lower, and certainly, it's you have to understand a little bit about how the grains trade. It's not necessarily that they trade as a complex because they're not tied together. To some extent, you can substitute corn and soybeans and wheat in some applications, but it's a little bit of a misnomer to even talk about the grain complex as a thing, because there's certainly room for a lot of play. However, having said that, we are beginning to see a downturn out of corn, and wheat is the one to watch. Wheat is still relatively stronger, but everything we see in grains, particularly soybeans, my published research, we do hold a short in soybeans. The entry was actually back here at very near the high of this day, and it was based on very similar patterns to all of the things we've been talking about today. We also, incidentally, hold a short in the euro, and the reason is, still very similar. Consolidations. These things do work. They work reliably. They generally lead to one thrust, so trade management is important, and that was the purpose of this video. Let's talk about some of the nuance, some of the finesse in these patterns, and also to moderate expectations. Remember, as swing traders, people talk about swing traders as a time frame, but as swing traders, what we're looking for really is one clean swing with as little give back as possible. So thank you for your time today, and if you found this someplace else, perhaps check out my blog, adamhgrimes.com. Thank you very much.